Welcome to the Radio Revenue Podcast.
Hey everyone, it is great to be here.
So today we have a really fascinating deep dive for you. I want you to imagine a bank that actually refuses to charge you overdraft fees.
Right, an institution that just, forgives your accounting mistakes.
Exactly. They spot you cash when you're short, and they just go out of their way to act like this incredibly patient, friendly neighbor.
But then, and this is the crazy part, imagine that exact same bank taking all of your accumulated goodwill and using it to quietly execute a $10 billion corporate takeover across the country.
Yeah, a totally ruthless takeover. It sounds like a complete contradiction.
It does, but it's actually, it's one of the most brilliant, highly calculated growth strategies happening in the financial sector right now.
And that is exactly our mission for today's deep dive. We are opening up the 2025 Form 10K for Huntington Bankshares Incorporated.
Yeah, Huntington.
Right. So for 160 years, this bank, which is headquartered in Columbus, Ohio, has had this image of being a sleepy, conservative, Midwestern staple.
Like the place that funds the local bakery,
Exactly. Or the neighborhood car dealership. But reading this annual report completely shatters that illusion. They are aggressively transforming into a national banking powerhouse.
And they're doing it at breakneck speed, honestly.
So fast.
Yeah.
But why should you, the listener, care about this? Well, this document is basically a masterclass on modern banking.
Oh, absolutely. It shows exactly how traditional brick-and-mortar banks are fighting off nimble fintech startups for your deposits.
Yeah. And it also serves as a massive warning flare about hidden toxic risks lurking in commercial real estate.
Which directly impacts whether small businesses in your local economy can actually get funding.
Right. So let's start with the foundation of this whole empire. In 2025, Huntington posted a very healthy $2.2 billion in net income.
That's a huge number.
It is. And the way they achieved that is deeply counterintuitive. They leaned heavily into what they call their fair play banking suite.
Yeah, the fair play suite.
To put it simply, they just decided to stop financially penalizing their customers.
Which, that goes against decades of traditional banking dogma.
Yeah, totally.
Historically, banks relied heavily on punitive fees, specifically overdraft fees, as this massive profit center.
Right.
But Huntington reversed course to heavily differentiate themselves.
And we've all been hit by the classic overdraft trap, right? You miscalculate your grocery bill by like $4, and suddenly you're slapped with a $35 penalty.
It's infuriating.
It really is. But Huntington's 10K outlines a totally different approach. They have this $50 safety zone.
Meaning if you overdraw by $50 or less, nothing happens. No fee.
Right. And if you go over that, they give you a 24-hour grace period to deposit funds and fix it before any penalty is applied.
Yeah, plus they offer asterisk-free checking.
And the technological integration in this suite is actually what drives the whole strategy.
Yeah, take their AI-driven tool, Money Scout.
Oh, that's a cool one.
It's not just a gimmick. The predictive algorithms analyze a customer's specific cash flow, like when their paycheck hits, when utility bills are drafted, and it identifies small, safe amounts of money the customer won't miss.
And then it just quietly moves those funds into savings, right?
Exactly. It's essentially tricking you into building a safety net.
I love that. And then there is my absolute favorite feature, standby cash.
Oh, yeah, that one is huge.
It gives customers a short-term line of credit.
Yeah.
But here's a kicker. They don't even look at your credit score to approve it.
Wow.
Yeah. They base the underwriting entirely on your actual deposit history with the bank. If you have a steady paycheck hitting that account, they'll just float you the cash.
It really feels like having a buddy who sponsors you a 20 at the register.
Exactly. But, I have to ask the cynical question here. How does playing the nice guy and intentionally walking away from millions in fee revenue actually generate billions in profit?
Well, it's by weaponizing that kindness to build an impenetrable competitive moat.
Okay, unpack that a bit.
Sure. So look at the current landscape. You have digital-first fintechs popping up constantly, promising no fees and sleek apps, right?
Yeah, trying to peel away younger demographics.
Exactly. Huntington uses these fair play features to lock in fierce customer loyalty, and that loyalty translates into a massive, highly sticky deposit base.
Got it.
By the end of 2025, they had secured $176.6 billion in deposits.
Wow. And sticky just means the customer opens the account and refuses to leave,
Right.
right? Because they actually trust the institution.
Exactly. And, in the banking business, your deposits are your raw material.
Right.
They're your absolute cheapest source of funding. If a bank has to borrow money from the Federal Reserve or the open market to fund a loan, it's expensive.
Yeah, the rates eat into the profits.
But if they use your checking account balance, they are paying almost nothing for that capital.
Oh, that makes sense.
So Huntington takes that incredibly stable, cheap $176.6 billion and uses it as the engine to power their highly profitable commercial lending operations.
So they are essentially buying cheap, loyal money with good customer service and then lending it out to corporations at a premium.
Yes.
So the friendly community bank routine is actually what funds the financial fortress.
Yep.
Which makes perfect sense. But that massive war chest of local deposits gave them the ammunition to do something completely out of character for a sleepy Ohio bank.
Oh, yeah, absolutely. They decided to buy their way into the South.
Yeah, I'm calling it their Texas two-step because the timeline in this 10K is just wild.
It is an unprecedented pace for acquisitions of this scale.
Yeah.
I mean, they are fundamentally rewriting their geographic footprint.
Right, so let's lay out the 1-2 punch for everyone. First, in October 2025, Huntington officially closed a deal to buy Veritex Holdings, which is based down in Dallas.
Right.
That cost them $1.7 billion, and it instantly added $12 billion in assets and $10.5 billion in deposits.
A huge move.
But they barely let the ink dry. Just 4 months later, in February 2026, they closed a staggering $8.1 billion all-stock acquisition of Cadence Bank.
Yeah, which operates out of Houston and Tupelo, Mississippi.
Right. So between those two moves, Huntington exploded to nearly 1,400 branches across 21 states.
And strategically, I mean, you can see exactly why they did it.
Why is that?
The Midwest is a mature, slow-growth market. But Texas and the broader South are booming.
Oh, for sure.
The population is exploding, corporations are relocating there, and the demand for commercial loans is skyrocketing. Huntington needed to deploy their massive deposit base into a high-growth environment.
Okay, I hear that, but I have to push back on this a little. They just spent nearly $10 billion in stock in a matter of months.
Yeah, it's a lot.
I understand the desire for Southern growth, but merging 3 different banking institutions at that speed sounds like an absolute logistical nightmare.
It's definitely risky.
You're combining entirely different IT systems, different leadership egos, and totally different corporate cultures. Aren't they biting off way more than they can chew?
Well, I would actually defend the aggression here, simply because in modern banking, scale is basically the only way to survive.
Really?
Yeah. The cost of cybersecurity, digital app development, and regulatory compliance is so astronomically high that you have to spread it out over a massive asset base.
But the bank's own management seems terrified of the logistics.
I see.
If you read the Cadence merger risks section of the 10K, they are explicitly warning investors that this could blow up in their faces.
Right.
They talk about severe business disruption and the risk of a mass exodus of key personnel from both sides.
True, but that is a standard risk disclosure. Though, to your point, the underlying threat of technological failure is very real.
Yeah, tell me about that.
When banks merge, the hardest part is integrating the core processors.
The core processors?
Yeah, the back-end IT systems that handle every single ledger entry, routing number, and debit card swipe.
Oh, wow.
If the mapping between Huntington's legacy systems and Cadence's systems isn't perfect, you get situations where customer accounts freeze.
That would be a disaster.
Payroll direct deposits get rejected, branches can't open. The risk of alienating that loyal customer base during the transition is immense.
And it's not just the IT systems they have to worry about, right? Because the sheer math of this Texas two-step triggers a massive invisible tripwire.
Yes, it does.
By acquiring Cadence, Huntington's total assets are being pushed well past the $250 billion mark.
Which is a huge deal.
Right, because in the banking world, $250 billion isn't just a big number to brag about on an earnings call. It fundamentally changes the laws of physics for how the bank operates.
That is the most critical structural consequence of this entire growth strategy.
Yeah.
The moment they cross that $250 billion line, they trigger a heavy, incredibly burdensome shift in federal regulation. They move from being a Category 3rd bank to a Category 3rd bank.
Okay, let's break down what that actually means, because the terminology is pretty dense.
It really is.
Up through the end of 2025, operating as a Category 3 bank essentially meant they were large, but regulators gave them a fair amount of breathing room. I think of Category 4 like driving a commercial delivery truck. You need a special license, you have to follow the speed limit, but you are generally left alone to do your rotes.
That's a solid baseline. But the 10K states that by the fourth quarter of 2026, their average assets will mathematically force them into Category 3.
Right, and moving to Category 3 is like transitioning from driving a delivery truck to flying a commercial airliner.
Great analogy.
Yes, you can carry a lot more cargo and make a lot more money, but suddenly the FAA is involved.
Exactly.
You have to do a grueling 100-point safety inspection before every single takeoff. The sheer weight of the regulatory compliance creates massive drag on your speed and your profitability.
And let's look at the actual mechanisms of that regulatory drag. Once they are fully integrated into Category 3, Huntington gets hit with strict new liquidity requirements.
Which one specifically?
Specifically, the liquidity coverage ratio, or LCR, and the net stable funding ratio, the NSFR.
So explain how those actually work in practice. What do those ratios force the bank to do?
They force the bank to stockpile cash and highly liquid assets, like treasury bonds, that can be sold instantly.
Okay.
Regulators want to ensure that if there's a sudden panic and a run on the bank, Huntington has enough cash on hand to pay every single depositor who asks for their money over a 30-day stress period.
Right, so they don't collapse.
Exactly. They want to prevent a situation where a bank has to hastily sell off long-term investments at a massive loss just to cover withdrawals.
But I mean, from a business perspective, if Huntington is forced to lock up billions of dollars in cash or low-yield treasury bonds just to satisfy regulators, that's billions of dollars they can't lend out to a construction company at an 8% interest rate. It actively suppresses their ability to make money.
Precisely. Furthermore, as a Category 3 institution, they are now legally mandated to submit a 165D resolution plan to the government.
Which is colloquially known as a living will.
Right.
But how does a bank actually plan its own death?
Well, it is a meticulously detailed blueprint showing regulators exactly how they could safely dismantle Huntington over a single weekend if the bank became insolvent.
Wow, just over a weekend.
Yeah. The goal is to figure out how to sell off the loan portfolio to a competitor on a Friday night so that by Saturday morning, regular customers can still use the ATMs.
That's intense.
And ensuring the broader U.S. financial system doesn't experience a catastrophic domino effect. Compiling that document requires thousands of hours of legal and financial modeling.
Unbelievable.
Add to that the impending Basel III Endgame rules, which is an international regulatory framework designed to force banks to hold even more capital in reserve to prevent another 2008-style crisis. And you have a massive compliance burden.
Okay, but this is where the 10K introduces a totally unexpected variable.
Right.
Huntington is getting hit with all these new Category 3 rules right at the exact moment the regulators themselves are in chaos.
Yeah, the geopolitical landscape is shifting under their feet.
The document specifically highlights the impact of the second Trump administration. And to be clear, we are just looking at the facts reported in the 10K here.
Right, exactly. We're just looking at what the bank is legally disclosing as a risk factor.
Right. So it notes that the new administration has sharply altered federal banking policies.
Yeah, they have actively reduced the workforce of the federal banking agencies and withdrawn mountains of previous regulatory guidance.
So to carry the airliner analogy forward, Huntington just got promoted to flying the jumbo jet.
Right.
But half the air traffic controllers have just been fired, and the remaining ones are rewriting the flight manuals while the plane is already at 30,000 feet.
It creates a tremendous amount of unpredictability.
I bet.
And because Huntington is entering this highly scrutinized yet chaotic regulatory space, both the government and Wall Street investors are putting their balance sheet under a microscope.
They want to know what's hiding in there.
Exactly. Everyone wants to know exactly what kind of underlying risk is hiding inside this rapidly expanding bank.
Which brings us to the most concerning part of the 10K. The Achilles heel of the entire banking sector right now.
Commercial real estate.
Specifically, office loans. Let's dive into the actual health of their loan portfolio, because this directly dictates how much money the bank can lend out to you and me.
Right. So Huntington maintains what is called an allowance for credit losses, or ACL.
Okay.
Currently, it sits at a massive $2.7 billion. This is their rainy day fund.
Gotcha.
It is capital they have explicitly set aside because their models predict certain loans are simply never going to be paid back.
Okay, but at first glance, the numbers actually seem okay. Their net charge-offs, meaning the loans they officially gave up on and wrote off as total losses, actually dropped down to $316 million in 2025.
True.
But if you read further into the asset quality section, a massive red flag appears. the non-performing assets, or NPAs?
Yeah, we really need to differentiate those two terms because it shows the timeline of a dying loan.
Okay, break it down.
A charge-off is a loan that is already dead and buried. A non-performing asset, an NPA, is a loan currently in the ICU.
Oh, wow.
Yeah. The borrower has missed multiple payments, they are in deep financial distress, but the bank hasn't officially pulled the plug and written it down to zero yet.
And Huntington's NPAs jumped 15% in 2025, hitting $945 million.
It's a huge spike.
Almost $1 billion in loans hovering on the edge of default. And the 10K breaks down where the bleeding is coming from.
Yeah.
There was a $105 million jump in commercial and industrial non-accrual loans.
Right, those are your standard business loans. Maybe a factory buying new equipment or a logistics company expanding its fleet.
Right. But more concerning is the $15 million increase in commercial real estate, or CRE, non-accrual loans.
Yeah.
And the bank explicitly singles out office loans as a toxic lingering risk.
The mechanics of commercial real estate financing explained exactly why this is happening.
How so?
Unlike a 30-year fixed residential mortgage, commercial real estate loans typically mature every 5 to 10 years. When that happens, the developer has to refinance the remaining balance. Right now, high interest rates are making that refinancing math completely unworkable.
Let's walk through that scenario for a second. You own an office building downtown. Your old loan had a 3% interest rate and it just matured.
Right.
Now you have to refinance at 7% or 8%. But because of the post-pandemic shift to remote work, your building is only half full. Demand for office space is dead.
Exactly.
So your rental income has plummeted, meaning the actual value of your building has collapsed, just as your monthly loan payment is about to double.
That is exactly the trap. The developer simply walks away, hands the keys back to the bank, and suddenly Huntington is stuck holding a half-empty office building that is worth far less than the original loan amount.
Wow.
That is how a performing loan becomes a non-performing asset.
But here is my question. They just bought Veritex. Veritex is based in Dallas and is heavily weighted toward commercial real estate.
Yeah.
How much of this toxic NPA pile is just inherited baggage from the Veritex acquisition versus bad organic bets that Huntington made on its own?
Well, the 10K acknowledges that absorbing Veritex directly spiked the NPA numbers right at the end of 2025.
Makes sense.
When you buy a bank, you buy their bad decisions along with their good ones.
True.
However, the internal economic models outlined in the report show that the broader macro environment is the true headwind here.
What are the models saying?
Huntington's own analysts project that U.S. unemployment will peak at 4.8% in late 2026, and that inflation will remain stubbornly above the Federal Reserve's target.
Which means the Federal Reserve isn't going to cut interest rates anytime soon. It's the dreaded higher for longer environment.
Exactly. And higher for longer is slowly strangling business banking customers across the board.
Yeah.
The longer rates stay elevated, the more these commercial real estate loans will mature and hit that refinancing wall.
So even as Huntington celebrates becoming a national player, that office real estate portfolio acts as a heavy anchor dragging on their balance sheet. Exactly. So let's zoom out and synthesize this entire playbook. We started with a local Midwest institution that essentially weaponized kindness.
Right.
They used their fair play strategy waiving overdraft fees and utilizing AI to help customers save to build an incredibly loyal, sticky deposit base. Then they took those billions in cheap funding and executed an aggressive Texas two-step, buying Veritex and Cadence to launch themselves out of the Midwest and into the high-growth southern markets.
Transforming into a $250 billion behemoth in the process.
Exactly.
But that very success forces them to navigate the punishing complexities of Category 3 regulations, an incredibly volatile political environment, and a commercial office sector that is still searching for a bottom.
And why should you, the listener, care about the corporate maneuvering of an Ohio bank?
Right. Why does it matter?
Because regional banks are the literal circulatory system of the American economy. They dictate the flow of capital to the businesses in your neighborhood.
Absolutely.
Understanding how Huntington is amassing power and managing risk gives you a lens to evaluate your own local bank. Is your bank building a war chest to go out and buy up the competition, or are they a prime target waiting to be acquired?
It also proves that the era of the quiet community bank might be over.
You really think so?
Yeah. The sheer cost of regulatory compliance and technological innovation means banks must either achieve massive scale or get swallowed by someone who already has.
Which leaves us with one final, deeply provocative thought to ponder.
Okay.
Huntington's entire identity, the rocket fuel for this massive expansion, was built on that fair play philosophy.
Right.
It relies on the illusion of a hyper-local, customer-centric relationship where the bank actually cares about your financial well-being. Can a bank maintain that unique, friendly soul when it mutates into a $250 billion corporate giant spanning 1,400 branches?
It's a great question.
Or does the unforgiving, ruthless math of national scale eventually erase the magic of the local touch entirely? You might want to keep an eye on those overdraft policies over the next few years.
It was a Revenue Radio podcast. Thank you for watching. Please like, subscribe, and hit the bell to stay updated with our latest analyses.